Hi again, welcome back to Modeliks. In this video we will show you how to accurately plan for your working capital. Working capital is crucial for day-to-day business operations, as it ensures that a company has enough short-term assets to cover its short-term liabilities. Adequate working capital is vital for maintaining liquidity, supporting growth, and ultimately ensuring the ongoing viability of a business. Here you see the three main working capital inputs: account receivable, inventory and accounts payable. Accounts receivable is money owed to you by your customers for goods or services already delivered. Quick collection is vital for healthy cash flow. Inventory is the stock of goods a company holds for sale or production. Efficient management balances meeting demand with minimizing costs. Accounts payable are amounts owed to suppliers for goods or services received. Timely payments are crucial for good supplier relationships and cash flow management. The easiest way to input is in these 5 large fields. Let's start with accounts receivable. As mentioned, this is money owed to you by your customers. First input is the percentage of credit sales, means which percentage of your customers pay you only after the service or product sale happened. Let's assume you manage to collect most revenues directly and only 25% of your sales happen on credit. Now enter how long, on average, it takes for your customers to pay you. Your target is to keep this as low as possible, but some customers may take time to pay. Let's assume a 45-day average period for your credit sales to arrive in your account. Up next, inventory. Here you need to input how many days of sales you hold in inventory. Assuming you know that you typically sell 100 goods a day, you want to hold some inventory, say 2 weeks, to not run out and to be able to serve demand peaks. Input 14 days here. Lastly, let's get to accounts payable. This relates to goods and services that you bought from your suppliers, but you have not yet paid them. To maximize your cash balance, you want to try to pay your suppliers as late as possible within your contractual agreement. Similarly as before, state how much of your supplier spend happens at credit. Let's say here that 50% of your suppliers want cash directly when the service happens, the other 50% give you credit, and on average they give you 2 months of credit until you have to pay, so enter 60 days. These are the basic inputs for your working capital. But if you have several products or services, chances are that you will have different terms for different products. You can enter more detailed assumptions by toggling these switches here below the inputs. Detailed masks will open that allow you to enter the same assumptions as discussed before on a product level so that you can accurately reflect the reality of your business. This is it on working capital, and concludes your forecast inputs. Congratulations! Next on to the reports.